Business owners, listen up. A new law just passed and it changes everything. We're talking permanent tax breaks, bigger retirement incentives, new reporting rules, and a surprise extension of the QBI deduction that could save you thousands a year, every year. I'm Grady Cool, founder of Cool Wealth Management, where I help business owners keep more of what they earn and use money as a tool to build the life they want. Today, we're breaking down the big, beautiful bill. What it means for you, your business, your taxes, and your wealth. This legislation is over 800 pages long, and it was designed to promote long-term reinvestment, make retirement more accessible, and simplify the tax code for small and mid-sized businesses. It affects 7 areas that business owners need to be aware of: qualified business income deduction, tax deduction and depreciation, retirement incentives, business entity advantages, compliance and reporting, succession and exit planning, and capital gains treatment. Let's break down each one so you know what matters and what you might want to do about it. The big surprise? The qualified business income deduction, short for QBI, was set to expire in 2025, has now been made permanent. That's a big deal. This allows pass-through entities like S-corps, partnerships, and sole proprietorships to deduct 20% of their qualified income before calculating their tax bill. For some, this lowers their effective rate from 37% down to under 30%. Of course, there are still limitations based on wages, property, and business type, but it does mean that we can start to build long-term plans around it. Before this, QBI was like that yogurt in the back of the fridge, always checking if it's still good. Now, it's good. For good. Next, deductions. The 179 deduction has been increased to $2.5 million. That means you can write off equipment, software, or vehicle purchases in full the year you buy them. No need to spread it over 5 years. Bonus depreciation is extended through 2028, then starts tapering off 80% next year, 60% the next, and so on. If you're thinking about investing in your business, now's the time. There's also a new 20% reinvestment deduction. If you put profits into employee training, domestic production, or energy-efficient improvements, you could qualify for a second deduction on top of the normal expense. Of course, the IRS wants documentation, so if your accounting system is a shoebox and a prayer, might be time for an upgrade. This bill makes it more attractive and more affordable to set up new retirement plans. If you have under 50 employees, you can now get up to $10,000 for 3 years as a tax credit if you set up a new 401k. There's a new defined benefit accelerator that lets business owners over age 50 supercharge contributions even in the first year. In some cases, that means over 6-figure deductions. And catch-up contributions now have to go into Roth if you earn over $150,000 per year, so heads up, high earners. Look, if you've been putting off retirement planning because it sounded either complicated or expensive, future you just called and said, "For the love of Roth IRAs, please start." This is a sneaky one that could either save or cost you thousands. How your business is taxed could be a massive deal. LLCs taxed as S-corps now qualify for the new reinvestment deduction and other tax incentives. C-corps earning under $5 million, reinvesting at least 60% of profits, get just a flat tax of 18%. So if your CPA set up your business structure years ago and you've never looked back, might be time for a second opinion. Tax code just reshuffled the deck. Now the not so fun part. Reporting. If your business earns over $500,000 per year, then you need to submit a yearly report for a reinvestment plan with the IRS. This includes how much you reinvested, contributions to retirement plans, and employee retention and training activity. If your QuickBooks isn't quick and your system is a spreadsheet called Final Real Taxes V2, we need to talk. Missing these filings could mean losing deductions or paying penalties. If you're thinking about selling or transitioning your business someday, this part matters. The bill raises capital gains exemptions on qualified businesses from $10 million to $15 million. But here's the catch. You have to have owned the business for at least 10 years, and you have to file a succession plan with the IRS before the sale. So if your exit plan right now is to just retire and figure it out later, you could be missing out on $5 million in tax-free gains. This new law is packed with opportunities, but only if you make use of them. So here's what you can do. Review your entity structure, look at your reinvestment strategy, max out your retirement options, clean up your books, and take QBI seriously. It's around for the long term. If you're not sure how this affects your business, or you just want someone to walk you through this is something I help with at Cool Wealth Management every day. Other than that, hope you enjoyed, and I will see you in the next one.